Ladies and gentlemen, good day and welcome to the Axis Bank conference call to discuss the bank's financial results for the quarter and year ended as on 31st March 2025. Participation in the conference call is by invitation only. Axis Bank reserves the right to block access to any person to whom an invitation has not been sent. Unauthorized dissemination of the contents or the proceeding of the call is strictly prohibited, and prior explicit permission and written approval of Axis Bank is imperative. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions at the end of the briefing session. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. On behalf of Axis Bank, I once again welcome all the participants to the conference call. On the call, we have Mr. Amitabh Chaudhry, MD and CEO, Mr. Rajiv Anand, Deputy Managing Director, and Mr. Puneet Sharma, CFO. I now hand the conference over to Mr. Amitabh Chaudhry, MD and CEO. Thank you, and over to you, sir.
Thank you so much, Michelle. My apologies to everyone for the slight delay in starting the call. Apart from Rajiv and Puneet, we also have Subrat and Munish, our EDs and other members of the leadership team. This quarter, we delivered steady core operating performance and lifted sequential total deposit growth higher than the industry. Our focus has been on profitable and sustainable growth. We continue to calibrate risk internally across our portfolios. Balance sheet is resilient and capital position continues to get stronger. Let me summarize the Q4 operating performance. Our core operating profit was up 11% year-on-year and 5% quarter-on-quarter. NIM was at 3.97%, which improved 4 basis points quarter-on-quarter. Period end total deposit growth picked up 7% quarter-on-quarter. On a year-on-year basis, deposit growth rates were similar for both period end and quarterly average basis at 10% and 9% respectively. On the lending side, focus on businesses with higher ROE continues. Small business, SME and mid-corporate together grew at 14% year-on-year and 3% quarter-on-quarter and constituted 22% of total bank loans. Fee to average assets improved and continues to be best amongst the peer private banks. Consolidated ROA and ROE stood at 1.88 and 17.11% respectively. The bank is well capitalized with a CET1 ratio of 14.67%, with net accretion of 6 basis points in Q4/25 and 93 basis points for the entire year. We stay focused on three core areas of execution of our GPS strategy, namely becoming a resilient all-weather franchise, creating multiplicative forces to build competitive advantage, and building for the future. I will now discuss each one of these areas. Over the last few years, we have significantly progressed towards building a resilient all-weather franchise. There are three areas of focus as we navigate the current cycle: deposit quality and growth, retail asset quality and costs, where we need to work on sustainable outcomes. On retail asset quality, a normalization cycle is in progress, and this should stabilize over the next few quarters. Our recognition and provisioning policies are perhaps the most prudent among Indian banks. On the cost side, our expense growth moderated to 6% year-on-year in financial year 25 from 30% in financial year 24. We have also seen an improvement of 9 basis points in our cost to assets in financial year 25 versus financial year 24. Let me move to deposits now. The deposit journey for Axis Bank should be looked at from three aspects: quality, cost, and growth. On the first two parameters, we have delivered well. We have improved the granularization of our deposit book, which positively impacts the quality of LCR deposits, consequently improving the outflow ratio by 340 basis points over the last 3 years is one such achievement and is now similar to large peer banks. We have also demonstrated controlled increase in cost of funds over the last 8 quarters, with only 7 basis points increase in the last 4 quarters. We have also opened 170 new branches in the last 3 months and 500 in this fiscal. Year-on-year MEB QOB basis, total deposits grew 10% and 9%, term deposits grew 14% and 14%, current accounts grew 6 and 6, and savings accounts grew 3 and 1% respectively. The new-to-bank acquisition engine for savings account franchise has trended well. In this quarter, we saw savings account new-to-bank deposits up 19% year-on-year and granular balances per account up 17% year-on-year. The bank has made focus interventions to ensure better engagements with the salaried customers and continues to see healthy trends with 18% year-on-year growth in salary uploads in the NTB salary book by March 25, 38% year-on-year growth in premium acquisitions in the new to the bank salary book by March 25. The premiumization of our franchise continues to progress well, led by 10% year-on-year growth in Burgundy assets under management. Axis Bank's Burgundy Private segment won the award for India's Best for Next Gen at the Euromoney Global Private Banking Awards 2025. On the wholesale segment, please refer to slide 33 and 35. Our industry-leading neo platforms, along with customized solutions across liquidity management, payments, and collections, continue to drive high transaction banking flows, leading to better current account balances. On retail asset quality, we continue to have one of the best asset quality levels across large peer banks in terms of net NPLs. And retail asset quality for unsecured products across industry, including MFI, a normalization cycle is in progress. The primary reasons are, and as is well known, credit hungriness and over leverage. MFI does not constitute a significant portion of our portfolio. It is 2.1% of retail loans. Recent regulatory actions have led us to adopt a cautious stance on this sector, both through direct and indirect sourcing. We have also strengthened the collections infrastructure, including use of tech-enabled front end to improve collections capabilities. We continue to work on creating multiplicative forces to build competitive advantage. We continue to innovate and remain open to new partnerships and collaborations. An example of this was during the quarter, Axis Bank became the first Indian bank to execute an aircraft financing deal. It involved a long-term US dollar loan for the purchase of 34 training aircrafts. This pioneering aircraft financing deal, structured end-to-end by our GIFT City team, is a strategic step towards creating a robust aviation finance ecosystem within India. We also continue to invest in building for the future. Digital banking performance continues to remain strong. In Q4, the bank introduced several new fraud protection-related initiatives also. We introduced an in-app mobile OTP as an alternate to SMS OTP. This industry-first feature significantly enhances security against fraud and takes away dependence on telecom networks, thus improving customer experience as well. The bank also introduced a safety feature on the Open App by Axis Bank. This provides customers the ability to control their digital channel usage at a granular level across internet banking, mobile banking, UPI, etc. Additionally, the bank continued to make progress in introducing new journeys and optimizing existing ones. Bank-wide programs to build distinctiveness through Bharat Banking and Sparsh is progressing well. The rural advances grew 7% year-on-year, and deposits from Bharat branches were up 9%, thereby aiding the PSL matrix. We have expanded our multi-product distribution architecture now to 2,736 branches. Sparsh 2, our enhanced customer experience program, simplifies interactions, drives NPS, automation, and digitization with a focus on customer loyalty and business growth. Our retail bank NPS score has matured significantly, rising to 159 from a baseline of 100 in the past 3 years. Softer aspects like our brand consideration score has also improved over the past few years. In closing, the bank prioritized profitability over growth, considering the uncertain macros and tight liquidity environment dominating most of financial year 25, while continuing to meaningfully invest in making the franchise more sustainable. As we enter financial year 26, we believe the operating environment is improving, which should help us drive both growth and profitability. I will now request Puneet to take over.
Thank you, Amitabh. Good evening, everyone. Our Q4 FY25 consolidated ROA was 1.88%. Our consolidated ROE was 17.11%. Our PAT was 7,117 crores, up 13% Q1Q. This operating performance was aided by a strong CASA growth of 10% QOQ and total deposits growth of 7% quarter-on-quarter. Our performance at a glance on operating performance basis, Q4 FY25 net interest margin at 3.97%, improving 4 basis points quarter-on-quarter. FY25 NIM at 3.98. Our Q4 FY25 fee income grew 12% YOY and 16% quarter-on-quarter. Retail fee grew 22% quarter-on-quarter. Our granular fees was 94% of our total fees. Our Q4 FY25 core operating profit grew 5% sequentially. Our Q4 FY25 and FY25 core operating profit grew 11% and 13% YOY respectively. FY25 operating expense growth moderated to 6.5%. Operating profit was reported at 42,104 crores, up 13% year-on-year. Our cost to assets at 2.46%, improved 9 basis points YOY. FY25 PAT at 26,373 crores was up 6% YOY. Our consolidated ROA for the full fiscal was 1.77%, and consolidated ROE was 16.89%. We continue to drive the franchise on an average deposit balance basis. The MEB growth was robust for quarter four. Our YOY MEB QAB basis total deposits grew 10% and 9%, term deposits grew 14% and 14%, CAR grew 6% and 6%, SA grew 3% and 1%. Our QOQ MEB QAB basis total deposits grew 7% and 2%, term deposits 5% and 2%, CAR at 16% and 3%, SA at 8% flat Q on Q. The MEB and QAB CASA ratio was 41% and 38% respectively. Average LCR during Q4 FY25 was 118%. Outflow rates improved by 340 basis points over the last 3 years. Our Q4 FY25 cost of funds remained in a tight range with a 7 basis points increase year on year. Our small business banking, SME and mid-corporate growth continues to remain healthy. SPB plus SME plus mid-corporate mix of advances stands at 236,342 crores. That is 22.8% of loans, up 750 basis points in the last 4 years. Our net advances grew 8% YOY, 3% quarter on quarter. Retail loans grew 7% YOY, 3% quarter on quarter. SME 14% YOY, 4% quarter on quarter. Corporate loans grew 8% on a year-on-year basis. Our small business banking loans grew 17% year-on-year and 4% quarter-on-quarter. Our mid-corporate book grew 10% year-on-year. We are well capitalized with a self-sustaining capital structure and carry adequate liquidity buffers. Overall capital adequacy ratio was 17.07% with a CET1 of 14.67%. Net accretion to CET1 of 93 basis points in FY25, 6 basis points in Q4 FY25. Overall capital adequacy remained healthy. Additional cushion of 37 basis points over reported CAR attributable to other provisions of 5,012 crores is not counted in the reported capital adequacy ratio. Our excess SLR is 1,14,609 crores. We continue to maintain a strong position in payments and digital banking. We continue to be amongst the largest players in merchant acquiring business with a terminal market share of 19%. Bank maintains a strong position in the UPI payer PSP space with a market share of 32% by UPI volumes. Open by Axis Bank remains amongst the world's top-rated mobile banking application in the Google Play Store and iOS App Store with a rating of 4.7 and 4.8 respectively. We have 15 million monthly active users on the app. Open by Axis Bank and Axis Pay have 15 million non-Axis Bank users, 30.1 million customers on WhatsApp banking, credit card safe market share at 14%. Our asset quality remains stable. Gross NPA at 1.28% declined 15 basis points YOY and 18 basis points QOQ. Our net NPA at 0.33% declined 2 basis points QOQ. Our PCR is healthy at 75%. On an aggregated basis, our coverage ratio is at 157%, improved 600 basis points quarter on quarter. Our Q4 FY25 gross slippage ratio is 1.90%. Our net slippage ratio is 0.81%, and our net credit cost is 50 basis points. Our key domestic subsidiaries delivered a strong performance. FY25 profit at 1,768 crores, up 11% YOY, with a return on investment on domestic subsidiaries at 46%. Axis Finance FY25 PAT grew 11% YOY to 676 crores. Asset quality metrics were stable, with an ROE of 14.51% for Q4 FY25. Axis AMC FY25 PAT grew 21% YOY to 501 crores. Axis Securities FY25 PAT grew 39% YOY to 419 crores. Axis Capital FY25 PAT grew 7% YOY to 161 crores. And we executed 44 ECM deals in the full fiscal 25. Thank you for your patience. We'd be happy to take questions.
Thank you very much, sir. We will now begin with the question and answer session. Anyone who wishes to ask questions may press star and one on their touchtone phone. An operator will take your name and announce your turn in the question queue. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Piyush Shukla from Hindu Business Line. Please go ahead.
Yeah. Good evening, sir. A couple of queries. One is your loan growth is at around 8%. Retail loans have also not grown much. So why are we seeing, this slower pace of growth in loans? I wanted to understand your NIM as well. Sequentially, it is up a few basis points. What contributed? Was there some sort of a IT refund that happened? Also on write-offs, if you can give some color, because in last 1 year it was the highest in this quarter. So from where do these, what were the segments you wrote off? Thank you.
Thank you for your question. Let me start with your last question first on write-offs. Our write-offs are all rule-based. We exercise no discretion on write-offs. The program that we follow is after an account is 100% provided, with the elapsation of time, the account gets written off on our books. So there is no discretion. This would have been regular flow-through of NPAs being written off after they've been fully provided. Broadly, given the environment, the write-offs for the current quarter would have been on the retail unsecured side. To your question on margin improvement, I would request you to look at slide 14 of our investor presentation. We've broken the margin improvement into interest reversal as well as spread. Interest reversal is a reflection of improvement on sequential quarter asset quality. So we've had lower slippages in the quarter, consequently lower interest reversal, therefore margin improvement. And there is roughly a 2 basis point spread improvement. In that 2 basis point spread improvement, there is a component of interest on income tax refund, but we had a similar interest on income tax refund in quarter one also of the current fiscal. On growth on retail assets, I'll request Arjun to kindly answer that question.
Yeah. Thanks, Puneet. So a couple of things on the retail assets growth. We've been calibrating our growth along the different segments which go into making up the retail assets book. We talked about it in earlier quarters as well, and that continues. And as we see early signs of improvement on that, we will be opening up the acquisitions on those segments as well. We had taken certain actions to tighten the kind of and calibrate the originations on our unsecured book, and we are seeing the early results, in fact, early positive results of that. So as we continue to see the improvements, we will build that back up. On our secured book, we will also be building that back up because that continues to hold well.
Okay, thank you.
Thank you. The next question is from the line of Vishwanath Nair from NDTV Profit. Please go ahead.
Hi. Sorry, couple of questions. The first one is around the quarterly average balance-based deposits. So if you were to compare that with your outstanding loans, just looking at that number, the CD ratio is a little tight. I'm just curious to understand if there is any worry at all on that front. The second part, now, when you're talking about your loan mix in terms of which interest rate regime they're linked to, 57%, according to the presentation, is linked to the EBLR, which means that gets repriced much faster than your broader deposit base. So I'm curious to understand, is that why your cost of funds has not actually come down? In fact, it's gone up a little bit. And is there an expectation that maybe Q2 might be slightly better? Also, one last point on the corporate book. Is there any concern at all with regard to the current tariff regime that is going on globally? Any worries on your corporate exposures?
Thank you for your question. So I think the first part of your question was the CD ratio on quarterly average balance basis. Yes, we have always maintained that we manage our balance sheet on quarterly average balance basis because that's what's sustainable and that's what drives the income profile of the franchise. On a reported basis, the CD ratio has moderated from last quarter to current quarter. Our CD ratio has dropped to 88%. To your qualitative question on are we comfortable operating the balance sheet at these levels? Yes, we are comfortable operating the balance sheet at these levels because We do look at other aspects, not just the CD ratio and balance sheet management. We look at our LCR and other liquidity variables, which we are comfortable with, reflected in the excess SLR and the consistent LCR performance we have. To your second question on loan mix and transmission, we have a policy to transmit rate changes at the end of the quarter in which the rate change has been announced. This policy exists for both upsides and downsides, so consequently, the disclosure that we've made on loan profile will get repriced as per this policy. I think your last question was on tariff. I'll request Rajiv to please take that question.
So, Vishy, we've actually done a...
Rajiv, I'm sorry, before you start, there was a point about deposit cost also. Sorry.
Yeah, sorry. Thanks for the question. I think on deposit cost, the assertion that deposits will reprice down later in the cycle, yes, we would agree with you that deposits will reprice with a lag from assets. But we've consistently maintained that please think about a bank balance sheet our size on duration basis. We've commented on the fact that the duration of assets and liabilities for us is near matched, and therefore we'll be able to compensate any asset pressures on pricing over the period of duration. We do not believe in monitoring our NIM performance on a quarter-by-quarter basis because there will be pushes and pulls on a quarter-by-quarter. If you look at full fiscal, we've demonstrated this to you in FY23 and FY24. One was a rising asset price cycle. The second was a rising liability price cycle. In both, we delivered NIMs of 4.03 and 4.07 respectively. So I think we do have a tight duration match, and we will play through this rate cycle basis the duration management of the balance sheet.
Thanks, Puneet, for that. Sorry, Rajiv.
On tariffs, we've done a fairly elaborate exercise, bottom up, looking at our portfolio. At this point in time, we don't see any material issues with the portfolio. But remember, there's so many moving parts, both positive as well as negative. We will continue to be watchful as this space evolves.
Thank you.
Thank you. The next question is from the line of Gopika G from Mint. Please go ahead.
Hi, can you hear me?
Yes, ma'am. Please proceed.
Hi. Good evening, sir. So my question is on retail loans. Of course, the growth in home loans, auto loans, credit cards have been quite low. How do you see this sort of panning out? What is the reason and how do you see this panning out? And secondly, on credit cost, it has fallen this quarter, so where do you see that settling going forward?
Hi, thanks for the question. I'll break it down into the three different components because the reasons tend to differ between the components of the loans which you mentioned. So we've seen a combination of factors, as I mentioned earlier, in certain segments where we saw signs of credit stress, credit hungriness. We did take actions. Those affected the disbursals. Those are the right actions to have taken. They're showing us the right results as we are seeing. On credit cards, there are two factors. There's also this first factor about the initial stresses that we were seeing. In addition, as you've seen in the market data which gets released, the spending levels on credit cards in terms of the year-on-year growth have actually come down a little bit, and that is also reflective of the slightly lower consumption that we've been seeing. So what we're seeing in recent months is indicating some sort of a pickup, but that is also seasonal. So that's the second factor. And the third factor which has affected certain segments is the slow and sluggish demand we saw in some of the underlying asset products, the actual assets which the customers purchase, be it homes or be it cars. I'm sure you've seen the data around the car sales numbers, particularly passenger car sales. So it's a combination of factors across multiple. There's a bit of the macro and there's also a little bit of what actions the bank took. So I think we now, if we look at where we see it panning out now, the actions that we took in terms of the credit tightenings are actually showing us good results on the unsecured portfolio. On the secured portfolio, we continue to see that holding up very well. So we are well placed to, and as we see liquidity coming back, we are well placed to start picking that segment up as well. So we're quite positive about the growth outlook as we go into the next couple of quarters. On the credit costs, I'll request Amit to share his thoughts.
Thanks, Arjun. So on the credit cost, we are seeing a normalization through the cycle. We've seen, through the troughs we've seen in 23 and 24. We do not expect to breach our 15-year averages on a through cycle basis, despite the higher provision. The only, place where we probably look at some amount of a stabilization or normalization to happen is unsecured retail, which again, like Arjun mentioned, we've taken proactive risk action. The early risk signs seem to indicate that most of the portfolios there are stabilizing, but we'll probably see out a couple of quarters for us to kind of look at that through cycle basis.
Okay. And in a broad question on profitability this quarter, so it's seen a YOY fall that's largely on account of slow growth in the retail portfolio.
Gopika, thanks for the question. I mean, I wouldn't call a 14 crore difference on a year-on-year basis a fall. It's probably flat is the best description I would have for year-on-year profit. The other element I'd like to draw to your attention is the differential on year-on-year is we had very large trading gains same quarter last year. And if you look at the core operating profit, there's been an improvement on core operating profit both year-on-year and quarter-on-quarter. Trading gains are episodic, very difficult to time in which quarter they flow through the P&L. So that's the gap that you're seeing. But my request would be look at the core operating profit. That's shown a growth both year-on-year and YOY, please.
Sure. Okay. Thank you. Thank you so much.
Thank you. The next question is from the line of Manojit Saha from Business Standard. Please go ahead.
Good evening. So if you see fresh slippages are up almost 1,300 crore, 1,400 crore year-on-year basis in this quarter as compared to the previous quarter, 3,471 to 4,805. Loan loss provisions also gone up by almost 500 crore. And predation and recoveries are down. So what is the reason for these higher slippages? Which are the sectors and this loan loss provision, which are the sectors again? And in conjunction with that, the trading gains have fallen sharply from more than 1,100 crore to around 100 crore. What is the reason for this sharp loss, downward trend in trading profit?
Thank you for the question. Let me answer the trading profit question first and then take the slippages question. As I previously responded to Gopika, I would request you to look at trading income on a full year basis and not on a quarter-on-quarter basis. On a full year basis, our trading income actually has improved on a year-on-year basis, which is how we manage the balance sheet. Timing of trading gains is very difficult to predict. They are dependent on many market variables, including timing of monetization of gains at our end. So my request is see the full year picture on a full year basis.
No, I wanted to know the falling income is due to bonds or equities.
So we don't give you color on what component of our investment book has contributed to gains or losses. I think the way I would like to address this question is on a full 12-month basis, 12 months FY23, we had 1,730 crores of trading gains. 12 months FY25, we've had 2,060 crores of trading gains. So we've net grown trading gains on a year-on-year basis by 19%. That will come from all parts of our business, debt, equity, derivatives. For the quarter, we agree with your observation, which I flagged off earlier. Q4 last year, we had 1,000 of the 1,700 crores of full year gains were booked in quarter 4. In this year, only 173 crores of the 2,060 crores of gains were booked in this quarter. Therefore, better way to look at trading gains is full year, and on full year, we have shown an improvement on that line. That was your first question. My apologies, I may have missed You had two questions for us. What would your second?
The higher slippages and loan loss provision in Q4 as compared to the Q4 last year, which are the sectors contributing to this?
Yeah, so effectively, I think on slippages, the way we look at it is the credit cycle is undergoing a normalization. FY23 and FY24 was coming off troughs on slippages. We've previously called out that the market and us have seen some stress on the unsecured book. That's playing through the fresh slippages line. There isn't any new comment or color that I would like to offer. It's just the normalization of the credit cycle from troughs, plus some correction on the unsecured retail book.
I mean, I've asked this because these are the two reasons why the profit growth is flat in Q4. That is why I thought I will ask about Q4. The other issue I wanted to ask is that credit card in force, CIF, earlier it was more than 1 million every quarter, the run rate. The run rate has fallen very sharply. It's now 70, 75, that kind of run rate. What is the reason, despite the city acquisition, the run rate has fallen this year? So for one quarter, none of the quarter has more than 1 million additions.
Manu, that's correct. Hi, this is Arjun here. And we had called this out over the last few quarters as well, that we have calibrated the acquisitions. There were certain segments where we saw signs of stress, and as I mentioned, we took early actions on those segments. Some of those actions included cutting down on the acquisitions in those segments where we saw those signs of stress. So as we see, and we had called this out, this specific number itself, we had called out a couple of quarters back, and we've been consistent with that. As we see improvement and stabilization, which we are seeing in the credit card portfolio, we will be bringing back the acquisition, but we'll be doing so cautiously and in a calibrated manner. So I can't give you a number about the million which you referred to, but obviously we are now looking at faster growth than we had, because we believe we're seeing the stabilization which will allow us to deliver on that growth. So it's consistent with our strategy in terms of unsecured retail and being cautious about that. As we see the signs improving, which we will pick the numbers back up again.
Okay, thank you. Last one is LCR. What was the LCR as of March 31st, and what is the impact of the RBI new norms?
So our LCR, our reported LCR is on slide 19 of our investor presentation. The LCR for Q4 FY25, we don't report LCR for a day. The LCR for Q4 on a consolidated basis is 118%. The second part of your question was around the RBI circular. The RBI circular is effective 1st April of next year. On a static balance sheet basis, we do believe that the circular is neutral in our context, but the balance sheet is dynamic and keeps evolving. So it would be more prudent for us to comment on this closer to implementation date than today.
Neutral as of now. Okay. Okay, thank you.
Thank you. The next question is from the line of Hamsini Karthik from Money Control. Please go ahead.
Hi. I'd like to ask my question drawing reference to the point made by Mr. Chaudhary in his opening remarks, where he talked about normalization of the stress in the credit cycle, retail credit cycle. What is on ground, Mr. Chaudhary, giving you the confidence to call out this trend? You were also the first to say that there is stress building in the retail space back in 22. So what's giving you the courage today? And consequent to that, we've also seen Axis Bank's growth rates, whether it's on deposits or on loans, on an FY25 basis, slightly underperform that of the market, especially if I were to compare you against the top 5 banks. So with this sort of confidence that you're getting on retail, do you expect Axis to grow at par with the market in FY26 or a little better than the market?
Thanks for the question. You asked quite a few things, so let me just try to cover them as quickly as I can. At a segmental level, corporate, SME, and retail secured book is holding up well. That has held up well through the last couple of years, so nothing new there. We see early indicators showing positive trends across product sets. These need time to mature. We would like to monitor these till at least end of first half of financial 26, and if they hold, for us to call out normalization, stabilization for this portfolio. So As you said, we are stabilizing, and I will have some specific comments on some specific asset classes, but stabilizing, not fully stabilized yet. Credit cost cycle is witnessing a normalization through cycle troughs seen in financial 23 and 24. Despite this normalization process, we do not expect to breach our 15-year averages, which is the comment made by Amit earlier, on a through-cycle basis, despite higher provisions cover of 15 to 20%. If we want to know outlook on unsecured retail slippages, overall we see stabilization in our cards portfolio. Personal loans may take a few more quarters to show improvement. We have obviously made more stringent its classification upgrade criteria for certain types of loans. This, we believe, will likely negatively impact both credit costs and upgrade recoveries in financial year 26 when compared to financial year 25. This coupled with seasonality of agri slippages in first quarter will keep slippages higher in the first quarter, and then we'll see from there on. I hope I've answered all your questions.
So the part on growth rate, we just skip that.
So I mean, I said in my opening closing remarks. Sorry to interrupt you. I said in my closing remarks that we do believe that we are reaching a stage, especially in the cycle, and I'll just repeat what we wrote, what we said. As we enter financial 26, we believe the operating environment is improving, which should help us drive both growth and profitability. So we are hopeful about financial 26. We also talked about the fact that the external environment does remain volatile, too many variables, too many things changing on a day-to-day basis. But the confidence in terms of growth and profitability is better than what it was at the end of the third quarter. Obviously, we'll keep watching the space very closely, and let's see how it goes.
But you don't want to put a number to growth right now?
No, we don't give any guidance on growth, either on deposits or on the advances side. But I think I've given you, through our comments, enough insights. Thank you.
Just one follow-up question I have. In terms of asset quality, in terms of the quality of earnings, etc., the bank is much well-placed compared to where it was on a pre-AQR basis. Would that give you a little bit more confidence to underwrite some of the high-yield, and if I can add, high-risk portfolios, particularly on the retail, because next fiscal is going to be a little challenging on the NIMS front as well. So you may want to compensate it with, high-yielding products. Is that a strategy that the bank would think about?
We have worked very hard to ensure that we operate within a certain zone of risk guardrails and the kind of risks we're willing to undertake. We have absolutely no intention to change that whatsoever. We believe where we are in terms of our market share, our presence in the market, we have enough opportunities to grow without sacrificing anything on the risk guardrail side whatsoever, or the kind of risk that you're willing to take. So please, we do not intend to change that course which we have taken over the last 4 or 5 years steadfastly. We believe enough opportunities exist, and we'll go and try to capitalize on those opportunities as we move forward.
Thank you so much.
Thank you. The next question is from the line of Suhana Sheikh from NDTV Profit. Please go ahead.
Hi, sir. I wanted to ask, your NIMs have improved on a quarterly basis. I know that you've already given the reason for that, but your CASA has improved, but you're also cutting rates on your, SA. And given that the LCR guidelines are also softer, which will get implemented from next year, I wanted an outlook on margins if you could provide us.
While we don't give any outlook on margins, I think what we're trying to say is it's a pretty dynamic environment. We've already seen 2 rate cuts. The market is talking about somewhere between 2 to 3 rate cuts going forward in the future. We need to ensure that we, continue to work towards maintaining our margins. The cost of deposits has started trending down. It's still some distance to go. And as part of that measure, we do believe that with all the rate cuts, that the time was right to reduce the return on savings. And like other banks, we've also done the same. I think the market, the rates will remain dynamic for some time before it kind of settles. It was something similar which happened when the rate rates started going up or the interest rates started going up. I think you'll see something similar when the interest rates are going down. So it's pretty much a part of the normal play out of this activity over the next couple of quarters. Thank you.
But are you seeing any near-term pressure on margins like other banks have called out?
Suhana, thanks for the question. I think what we've consistently maintained is we do not believe a franchise our size should look at margins on a sequential quarter basis. Duration of our assets and liabilities are tightly matched. Effectively, therefore, we should have the ability to manage NIMs over the duration of our balance sheet. Yes, if you're asking me a pointed question on will the industry see NIM compression in the quarter in which rates are cut, yes, that's going to be an industry phenomena, and all participants in the industry will work towards managing it basis the color and construct of their assets and balance sheet. I think that's where we would like to leave that response at, please.
Thank you.
Thank you. Ladies and gentlemen, due to paucity of time, kindly limit your questions to one per participant. Thank you. We'll take the next question from the line of Ritu Singh from CNBC. Please go ahead.
Hi, Mr. Chaudhary, again, going back to some of your opening remarks where you said, the bank right now prioritize profitability over growth, given the uncertain environment. I'm wondering, apart from unsecured, which of course you've been calling out and you say you would pick it up as and when the environment improves, are there sectors or other segments you're particularly focusing on for profitability, and where do you expect some lag in growth? And also MFI, why you say it's not a large book? When you say you've taken a more cautious stance, will we see a degrowth in the book, or what should we expect going ahead?
Ritu, thank you for your question. In terms of MFI, effectively, I think the comment Amitabh was looking to make is we saw stress in the MFI market space. We took credit actions in order to curtail the MFI book disbursements. Consequently, there is an impact on MFI book growth. As we get the confidence that the MFI cycle is playing through, we are interested in that space from a lending perspective, but we will dial up growth only once we are comfortable that the credit environment is suitable for us to lend to that segment. We continue to watch that space. It is PSL accretive for us, so that space will be a space that the bank will be present in. The second part of your question, or rather the first part of your question, was what are the segments that we would look to grow as and when opportunities come our way. We have called out consistently that as part of our GPS strategy, there are 5 segments that we are looking to grow in, which is mid-corporate, SME, Bharat, retail assets, and the small business banking space. In our internal world, we call them our focus segments. They will continue to remain our focus segments as we look to grow in the next fiscal.
Okay, and a quick word on these are just rumors that have been around about 100 or more senior employees at the bank being laid off recently, if there was any truth to that.
Ritu, I mean, as part of normal process in any institution, we at the end of a financial year, we go through a pretty detailed appraisal cycle. As part of that appraisal cycle, there are a large number of people which are rewarded in terms of certain ratings. Large people get promoted. There are some set of people whose performance is below par, and there are some tough conversations which happen. So, I would not like to comment on, what you're referring to, but this is pretty much a par for the course for any institution. Now, obviously, in the banking industry, there are some parts of our business which are going through some challenges. There are some parts of the business which are doing quite well. So on one side, bank is investing heavily in certain areas. In some areas, obviously, given the performance, given how some people might have fared, we might see some individuals exiting. But that happens every year. So nothing unusual.
Is there a number you could put to it? The number of layoffs that have been because of performance-related issues?
No, we don't put out this number. I mean, These are all based on normalized curves, so there's absolutely no, we don't give any guidance or a number of that nature whatsoever.
Sure. Thank you.
Thank you. The next question is from the line of Anshika from Mint. Please go ahead.
Hi, good evening. So you mentioned that the incremental loan quality on the retail side is getting better, but given that the slippages and the write-offs are elevated during this quarter, could you elaborate on the SMA, the trends in the SMA book and where it stands right now? And especially given that last year in Q1 it flagged some asset quality issues in the agri book and collection being hit. Could that continue to weigh on asset quality in Q1 then? How are you seeing the trends going forward?
Anshika, thank you for the question. We do not share SMA data publicly, so that's information that we will not be able to provide to you as a response to your question. Insofar as the write-offs are concerned, our write-offs are all rule-based. So if an exposure is 100% provided for on the retail and SME book, it gets written off X months after the account is fully provided. So the numbers within quarters are not judgmental, they are purely program-based, and therefore a certain set of accounts would have gotten fully provided and therefore would have been written off in this quarter. The third part of your question was around how do we see the credit cycle. I think we made three comments there earlier in this conversation, which I would request to reiterate. First is, at a segmental level, corporate, SME and retail secured book is holding up well. The early indicators are showing positive trends on the unsecured portfolio on certain products. We would like to see these new underwritten vintages to mature, and then we provide a data-backed outlook on asset quality. Overall, I think your question, the last part of your question was how do we see the sequential performance. My request to you too is note that quarter 1 and quarter 3 for the industry does have agri slippages, and there's a seasonal impact of slippages. So if you look at our past behavior, quarter 1 slippages have normally been higher than quarter 4 slippages due to seasonality. And I don't think that trend's going to break.
So just because you mentioned that just one clarification, that the write-offs are of course rule-based, but just to understand the pipeline of loans that could be maturing in the next quarter or so, that is, I'm trying to understand that maybe the trends in the SMA book is not the absolute figure.
Okay. Again, we do not give you information, but I can guide you to a proxy. If you look at slide 48 of our investor presentation, we report the closing balance of gross NPA at 14,490 crores. We run with a provision cover of about 75%. That broadly, if you break that book up, some part of that book will be 100% provided, and some part of that book would not be 100% provided. If you did this analysis over time, you would get a good proxy of what could potentially be write-offs coming through in quarter 1 of next year. So we put out enough information for you to make an educated guess, but I can assure you that the write-offs are program-based and there isn't episodic or choices made in that portfolio.
Sure, thank you.
Thank you. The next question is from the line of Advait Rao from Bloomberg News. Please go ahead.
In the financial statement, it shows that you have sold about 16,000 crores or assigned 16,000 crores worth of corporate loans. Just want to understand, is this a large amount? Why the assignment? And is this par for the course? Do you expect to do a sizable amount in the following year? Just wanted to have understanding on the rationale behind that.
Thank you for the question. I think you're referring to note 8B of our results, AFR presentation, AFR results. I think it's important to read that note in context. Our syndications business, which may book an asset and then sell it down as part of the syndication strategy, gets recorded in that segment. The 16,000 is on a full year basis and not for the quarter, and a dominant part of the 16,072.15 crores would be a result of our syndication business. So that's syndicated related sell downs, not anything to do with asset quality or business related sell downs.
Okay. Just in terms of where I'm just putting two and two together. Mr. Chowdhury said that there was some slowdown in customer demand across some assets like cars, home loans. Maybe that is rebounding. Maybe that will rebound with the budget and the repo cut going forward. But at the same time, on the corporate end, tariffs, the outcomes of that, the outcomes of geopolitics, maybe corporate demand for loans is not going to be there. Just in terms of your SME book, because that's the fastest growing segment, at least this year, is there a mix that you're looking at to end up, because it's still a small part of the overall loan mix, retail dominates and corporate SME not so much. Is there a sort of mix you're targeting? And just color on the SME sort of landscape, is there hunger amongst SMEs for credit?
On tariffs, at the beginning of the conversation, I did speak about the fact that we actually did a fairly elaborate bottom-up as far as the impact on portfolio, on the corporate portfolio is concerned. At this point in time, we don't see too much of a problem. But having said that, I mean, there are both, lead lags, pulls on both sides, which are currently playing out. This is a space that is evolving, and we will continue to watch the space itself and its impact on our portfolios. I don't think tariffs are impacting demand for money at this point in time. Corporates continue to be cautious as far as private capex is concerned, but more importantly, there is ample cash on corporate balance sheets at this point in time. So therefore, do expect that corporate demand going forward will be relatively muted.
So on the SME part, just in terms of how much do you want to grow that business? This is 7%, if I'm not mistaken. Also, it's the smallest part of your loan mix. How much do you want to grow that? Is there high demand from SMEs for loans?
So our book composition is 60% retail, 11% SME, 29% corporate. SME is a focus segment for us, and we've previously stated that we would like to grow our focus segments. What gives us confidence to grow in the SME space? I would request your attention to slide 40 of our investor presentation. The book is granular, so less than 5 crores is 40% of the book. The book is diversified by geography. We have no concentration. The book is diversified by industry. Again, no concentration. What's even more interesting for us in this space is 70% of our book is short term. Therefore, it pays for itself reasonably quickly. And 87% of our incremental sanctions are in the SME 3 and above rating. And on a full book basis, 71% of the full book is SME 3 and above. So the book is well rated, well diversified by value, by geography, by industry, and typically short term in nature. That's the quality of the SME book that we have built over time. That's also reflected in the fact that we do call out that SME slippages are near negligible on a net slippage basis for the last 5 to 6 quarters. And consequently, that's giving us confidence to grow this business as we move forward.
Thank you, sir. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mr. Puneet Sharma for closing comments. Thank you, and over to you, sir.
Thank you, Michelle. Thank you, everyone, for taking the time to speak with us this evening. If there are any questions that remain unanswered, please do reach out to our corporate communications team or Piali. We'd be very happy to pick them up. Thank you and have a good evening.
Thank you, members of the management. On behalf of Axis Bank, thank you for joining us, and you may now disconnect your lines. Thank you.